Okay, this is practice problem number 1 for chapter 23. And this is in regards to management or the company making a decision on whether or not to perform further investigation on favorable variances and also unfavorable variances. As we can see here, that's within this exercise. So we have direct materials, direct labor, and overhead variances here that's shown here. And these are all cost variances, by the way, meaning that we're only focused on the cost, not the sales or revenue. This is all cost variances here. So we see we have some favorable variances and also some unfavorable variances. And it's telling us that the company investigates all of the variances of $400 or more. So what this means is that companies don't necessarily investigate every single variance in each field. They don't do that. That would take too much time. So what the company will do is figure out um, an amount or a threshold of what they deemed as something that needs to be looked further into. So that amount could be, $100. It can be $1,000. It could be $10,000. It all depends on the complexity of the business and the size of the business to figure out what amount is going to be deemed as a significant or making a significant impact on the financials, and that needs to be looked into further. So in this case, it's $400 or more for both favorable and unfavorable variances. So before we get into making that determination on what the company is going to investigate, I want to first go over the variances that I have listed here and the formulas that are associated with these variances as far as how to calculate them. So we have the price variance. Okay, the price variance is just going to focus on the price. And again, these are all cost variances. So we have for the price variance, in order to calculate that, you have to take the actual price, subtract out the standard price, and multiply it by actual quantity. Now, the word standard is also known as your budgeted price. So standard price, standard is budget. Now, when it comes to determining whether the variance is unfavorable or favorable, it's going to be determined based on the difference between the actual price versus the standard or budgeted price. So if the actual price is more or greater than the standard or budgeted price, then that lets you know that that's an unfavorable variance. Conversely, if the standard price is greater than the actual price, then it lets you know that that's a favorable variance. Now, the reason why is because, well, if you've budgeted more costs than what actually occurred, then hey, that's a good thing. That's a favorable variance. But budgeting too much costs can be something that needs to be looked into because that's going to show a significant favorable variance that you need to investigate because maybe there's some cost that you could take away and allocate it somewhere else to where that those costs that you allocate to another area could be you know used to be more efficient or more productive in order to produce items to further generate revenue or sales. So things like that, as far as with what to do if there's a significant favorable variance, because that's a great thing, but you want to look into it to see if you can allocate some of that cost somewhere else because it didn't actually happen. But if the actual price is greater than the standard price, then that's an unfavorable variance. That means that what actually occurred in costs was more than what was budgeted for. Now we go down to quantity variance. Quantity variance is calculated by taking actual quantity, subtract out the standard quantity or budgeted quantity, and multiply by standard price. Now, when it comes to the standard price, that isn't the focal point. The focal point is quantity. So you can use, or for this one here, just to make some clarification here when it comes to when we go back up here to the price variance, we see that they're using actual quantity versus quantity variance, they're using standard price. When it comes to standard price and actual price, they don't really vary significantly. In other words, they don't differ significantly. So it's okay to use standard price for this one because the focal point is quantity anyways. That's what you're focused on. And the actual quantities and standard quantities, they could be significantly different, but the standard price and the actual price, or standard price versus actual price, they don't really differ significantly because what you are setting as the price, so the cost, the actual cost, per item or per unit, it doesn't really differ that much as far as with taking the standard price and actual price per unit. But the quantities can differ significantly, which is why the quantity variance here, this is why it focuses solely on the quantity. So quantity variance, again, is actual quantity minus standard quantity. Again, that's budgeted quantity multiplied by standard price. And so if the actual quantity is greater than the standard quantity, then that's going to be an unfavorable variance because, again, we're focused on the cost. And conversely, if the standard quantity, budgeted quantity, is greater than the actual quantity, then that's going to be a favorable variance. So that's a good thing. So just like the price variance, if there's a significant favorable variance, you want to look into figuring out why. Maybe again, there's some, the quantity, the number of units may need to be adjusted somehow, and again, this is a cost, right? So if you adjust it a lot lower, then that's going to impact the company's costs for production in a positive way. So again, that would have to be something that needs to be looked into. And also, when it comes to the actual quantity being greater than the standard quantity, that's going to be an unfavorable variance since we're talking about costs, and the company may need to figure out, do they need to actually increase their costs in their budgeted units? Maybe they need to adjust the budgets on their end. It's basically just you as management in the company. You're just basically looking into this, to the cost further, because that's all you're doing. You're comparing what you budgeted for versus what actually happened, and then whatever the variance is, whether it's favorable or unfavorable, make some adjustments, figure out why, do some investigation, and then make some adjustments accordingly. That's it. That's the goal here. So then we drop down to efficiency variance. So efficiency variance focuses on, well, it is efficiency, so hours. How efficient can you complete a task? And that is determined based on hours. So we're going to it's calculated by taking actual hours, subtract out standard hours, budgeted hours, and multiply it by standard rate. Again, when it comes to the standard rate versus actual rates per hour, because this is in relation to an employee's wage per hour. That doesn't really fluctuate that much, the standard versus actual, because the standard rate, the budgeted rate, is going to come from what the employee actually makes per hour, which is why the standard rate doesn't really, it doesn't differ significantly from the actual rate. But what could differ significantly are the actual hours versus the budgeted hours in producing units. Hopefully that makes sense. So if the actual hours, because this is direct labor, if actual hours is greater than what was budgeted for standard hours, then that's going to be an unfavorable variance. Conversely, if the standard hours was budgeted, if that's greater than the actual hours, then that's favorable. That's a good thing. Now, if it is favorable and if it is a significant difference, then the company can determine whether or not they need to reduce the hours or allocate those hours in another area to increase the production over there, to you know, drive or generate more sales. That's all going to depend on the company. And then we have overhead variance. I did leave one of the formulas out here, but I wanted to just give you an overview on these variances here. So overhead variance just focuses on overhead. It's everything else that is needed in order to actually operate your business or produce items. So if overhead, actual total overhead is greater than standard overhead applied, um, that's going to be an unfavorable variance, meaning that what actually occurred is greater than what was budgeted for. And conversely, if what was budgeted for is greater than what actually occurred, then that's favorable. But you want to look into it further if the variance is something that's significant to the company. And the last one here, we have volume variance. That is when the budget overhead is subtracted from standard overhead applied. So this one here, if what was budgeted is greater than the standard overhead applied, then that's going to be either a favorable or an unfavorable variance. That's going to depend on the company. Okay, so what was budgeted versus what was applied. When companies are applying the overhead, they are simply just using a technique in order to just artificially apply the overhead. So it's like an estimated amount. Budgeted is also the same thing, it's estimated. But what was actually applied versus what they actually budgeted for, they want to actually compare the two to figure out, okay, which one is good or bad, which one is going to be positive or negative. So that's volume variance. It's no difference than these other variances here as far as with the concept. Now we can go up here to the exercise, and I'm going to put a check mark on the ones that we need to look into. Now they did say we need to investigate all variances of $400 or more. So we start off with the direct materials price variance. It is $300 as a favorable variance, so we don't need to look into that further. The second one here, direct materials quantity variance, that's a $3,000 unfavorable variance. Yes, we need to look into this further, so I'm going to circle that one. Next, we have direct labor rate variance of $100 unfavorable. We do not need to look into that further or investigate further because that's below $400. Next one, we have a direct labor efficiency variance of $2,200 favorable. We do need to look into this further, even though it's favorable, because that is a significant difference between 2,200 and 400. So this is a good thing, but maybe when we go down to the efficiency variance, actual hours and standard hours, this is letting us know that standard hours was greater than actual hours by 2,200. So maybe we need to cut down on the hours, which means that we can cut down on the cost, or allocate those hours to somewhere else, another area that needs it. Next, we have overhead controllable variance. So that's a $400 unfavorable variance. That's right at $400. We do need to investigate. Next, we have overhead volume variance of $500 favorable. Yes, that's something we need to also investigate because, hey, their threshold is $400 or more.